This video lecture is all about giving you an exam-focused approach to IFRS 18 presentation and disclosure in financial statements. My name is Tom Clendon, and I am an ACCA tutor expert, an online lecturer. And my vocation is to help you to pass this final level accounting examination. You can find examples of my material through podcasts and on YouTube. What I am looking at today, however, is very specifically an explainer around IFRS 18. And the two areas that I'm going to focus on, the exam focus, is going to be on the 5 categories in the P&L and the 3 subtotals, the changes made there, and MPMs, management defined performance measures. Now, before we go any further, I want to make sure that you will know what I'm going to be talking about. I want to put an exam focus on this. There is a brilliant article written by the examining team on this area, and you must have read, nay, even studied that article before progressing on to this video. Otherwise, you're not going to get the most out of this video. That's what the article looks like. It's on the ACCA website. Thank you for your patience. If you are jumping off now, welcome back when you come back having read the article. But I'm assuming that you are familiar with this article. That way you're going to get the most out of this video. Because I believe in application, application, application. That's what the examiner believes in. It's not just about regurgitating facts. It is about interpreting, applying, and understanding. And I'm going to start by asking a general question. Why? Why do we have this standard IFRS 18? I mean, it's on presentation and disclosure, so it's got nothing to do with recognition of assets and liabilities. It's got nothing to do with measurement of assets and liabilities. It's a standard that replaces ISA 1, an old standard, but it takes it further. And it takes it further with these P&L disclosures and with this idea of MPMs. Now, the language that I'm going to use, and I would encourage you to use if you were asked to explain why the standard has been introduced, the language I would ask you to use is the language of the framework, of the conceptual framework. Now, when you think about what the standard is doing in defining the 5 income and expenses, in requiring disclosures around management defined performance measures, it's introducing comparability. It's making all companies define and present their P&Ls in a similar way and to make the disclosures around their own performance measures that they've defined. And that's going to enhance comparability for the investors, for the users of financial statements. And those disclosures and that comparability can only enhance the understandability that investors will have. That's a good thing. These are enhancing the usefulness of financial statements. The disclosures are going to give transparency, consistency, comparability. And ultimately, therefore, it will improve the usefulness of the financial statements. It's going to make them more predictable, more relevant. It's going to make them more complete, a better, faithful representation. I am a fan of IFRS 18 because it's helping investors users gain a better understanding of the financial performance of the business. And there is nothing more important for your average investor is to understand the profit the company has made. It's why they've invested in the company. So, look, the P&L, the standard talks about there being 5 categories of income and expenditure in the profit and loss account. Now, you won't necessarily see these 5 words, these 5 or 3 words or 2 phrases. You won't necessarily see them because They're a little bit of the architecture. They're a little bit of the underpinning of the profit and loss account. Now, the classification of income and expenses between those 5 headings is done on the nature of the asset or liability to which it's derived. So take depreciation. If we're talking about the depreciation on an investment property, which can be the case if you have an investment property at cost, if that's the policy, then the nature of depreciation on an investment property, the depreciation would be in the investing section of the P&L. But if the depreciation was on PPE, PPE is an operating type asset, so the depreciation on the PPE would be in, I don't know, cost of sales, administration expenses in the operating section. So the classification of income and expenses depends on the nature of the asset or liability or transaction from which they're derived. And we're going to test that out. We're going to test your understanding of that out in just a moment. But for the avoidance of any doubt, let me explain how we classify each of the 5. The bottom 2, I think, are self-explanatory. Discontinued operation, IFRS 5, you've got to know that. Tax is tax is tax, covered by ISA 12. Financing. Some liabilities, are exclusively to do with raising finance. So convertible loan stock, issue of debentures, loans. And therefore the effective rate of interest, the interest expense, that's financing within the P&L. All right? But you'd also have the unwinding of the discount, the finance costs on leases, on the unwinding of provisions, decommissioning, that sort of thing, and even on the deficit of defined benefit pension schemes. Now, you've got to be a little bit careful with the expenses in connection with defined benefit pension schemes, because the actuarial gain or loss doesn't even go in the P&L, goes in OCI. And of course, the current service cost, that would be an operating expense. But the unwinding of the discount on a deficit, that would be regarded as a financing expense. Now, investing. The income and expenses that are relating to investing are basically coming from assets, underlying assets, which are independent of other resources. So I'm thinking about an investment property. I'm thinking about an investment in a joint venture. I'm thinking about an investment in an associate, or an investment in a fair value through OCI or a fair value through P&L, investment. So the share of profit under equity account, the income from investment properties, that will be regarded in the investing section. Having defined 4, operating is the rubbish. Operating is the default. Operating is the day-to-day stuff. All right. Now, you've got to be a little bit careful, because strictly speaking, you have to consider the business model. Because if the business just is about investment property, then that's its operating income, that's its operating activities. You wouldn't then have the income from investment property in your investing section if the business model was exclusively around investment property or exclusively around providing finance. So it's just a little bit of a funny exception there that you need to be aware of. I also just want to flag up about aggregating items, which have dissimilar characteristics. You shouldn't do it. You shouldn't do it. So you might have in operating, let me give you an example. You might have in operating, things like administration expenses, wages, depreciation, etc. But they are fundamentally different from buying and selling, the purchase of goods. So you'd have that in cost of sales. And it's fundamentally different from the impairment loss on goodwill, for example. Fundamentally different from day-to-day administration expenses. So you would disaggregate your operating expenses into separate lines so they made sense. All right, and I'll show you an example of that in a moment. So let's crack on. Let's see some application as to how certain expenses are going to be classified, or certain income and expenses are going to be classified within the five underpinning items in the P&L. A retailer importing goods, so buying goods on credit in a foreign currency, there will be exchange differences on the settlement or on the retranslation of that monetary item. Same with the overseas loan. There will be, that's a monetary item that will have an exchange difference arising. And the issue is, how are they going to be categorized? How are they going to be presented within the profit and loss account? And I'm kind of hoping that you're going to be one step ahead of me. So there are 5 possible answers to where the exchange difference on a trade payable is presented. Well, it's not going to be discontinued. It's not going to be income tax. Let's deal with that. The nature of the liability is not to finance the business, and it's not an investment either. It's not a source of income from an independent resource. So it's operating. Yeah, it's going to be operating, and that is intuitive, I think. The overseas loan is financing the business. The nature of the underlying asset or liability, in this case liability, is financing the business. So therefore, the exchange difference arising on the retranslation of the overseas loan is dealt with in the same way as the effective rate of interest as the finance cost on that loan. It's an interest expense. It's an interest expense, not part of cost of sales or anything like that. It's an interest expense. Okay? Different example. A manufacturer has impairment losses. Now, where the impairment loss goes depends upon the fundamental nature of the underlying asset. Could be on PPE, could be on the investment property. Now, when you have an investment property at fair value, you won't have impairment losses. But if you have an investment property at cost, and there's an indication of impairment, then there is an impairment review. And if there's an impairment loss, the impairment loss goes through the P&L. So we can have impairment losses on investment properties through the P&L. How are they categorized? Well, the underlying nature of the investment property is investing. So you would therefore logically expect it to be an investing in the P&L. But when it comes to the impairment loss on the PPE, it doesn't fit in any of the 4 categories. It therefore is in our default, which is intuitive. It's in the nature of an operating activity that you've got PPE. It helps in the general running of the business. So it's an operating item. I wonder if you got 4 out of 4. I hope you did. I hope you did. Now, there are 3 subtotals in the P&L that are required under IFRS 18. Operating profit or loss. The profit or loss before financing and income taxes, that's required, even if it's the same figure as operating profit. And of course, we need a total to the P&L. Yeah, the profit or loss for the year. Now, P&Ls will also be presented with other comprehensive income underneath, because not all gains and losses go through the P&L. But those are the 3 mandatory required subtotals and totals within the P&L. Others may be given, but these are the 3 which are required. Now, this profit and loss account that I'm showing you now is an example of a profit and loss account that is compliant with the requirements of IFRS 18. You don't have to use the exact wording. You can see there's a cost of sales, 213. If it's a service company and they're not buying and selling goods, you wouldn't have cost of sales. Wouldn't be appropriate to have cost of sales. So let's have a look why it's compliant with IFRS 18. One of the reasons it's compliant with IFRS 18 is that the 3 totals that are required, mandatory required, are shown. Operating profit, profit before financing and income taxes, and just bottom line profit. So all three headings are there. Now, gross profit is there, that's optional. Profit before tax is there, that's optional. Yeah? So the three mandatory ones are there. And then the expenses are there, the 5 categories of expenses, the hidden architecture. We start with operating. And you can see that the goodwill impairment loss has been disaggregated usefully. Yeah, it's not because it's of a very different nature than selling expenses and other operating expenses. You can see that we've got a share of profit from associates, and income from joint ventures will be there as well. Alongside that, would be income from investment properties, depreciation on investment properties, profit loss on the sale of investment properties, whatever in the investing activity. Then you have the financing activities. And then finally, of course, you have income tax and discontinued. And they appear a little bit more to the surface and obvious because they say income tax and discontinued. So I repeat, this is an example of a P&L which is compliant with IFRS 18. And one of the ways that can be tested, that IFRS 18 can be tested, is to give you a profit and loss account which is not compliant with IFRS 18 and challenges you to identify where it's deficient and challenges you to perhaps make corrections and certainly explain what's going on. Application, exam focus. So here we have it. We've got to evaluate this draft financial statement, this draft P&L for compliance. And there you see on the right hand side of your screen, yeah, revenue of 1,500, profit of 200, and everything in between. Now, included in operating expenses is an impairment loss, and this is on goodwill. And included in operating expenses is an impairment loss on the investment in the associate. Now, in some ideal world, you would have already thought of 3 things to say, of 3 deficiencies, of 3 problems, of 3 non-compliances with IFRS 18. The way that the P&L is presented on the right-hand side, there are 3 things that are wrong. Maybe you should pause the video and think about the 3. That's more educationally valid than simply learning the answer. You've got to think. Now, if you have paused the video, think about why you've been given the information about the impairment losses. It is technically correct that the impairment loss on goodwill is dealt with as an operating expense, but I think it should be disaggregated. I think it should be separated out. I don't think operating expenses should be 800. I think they should be 700. Other operating expenses 700, and then impairment loss 100. That would be a better presentation. So one issue is, I think, although the impairment loss is correctly categorized, it needs to be disaggregated. Secondly, you were told that operating expenses include an impairment loss of 50 on the investment in the associate. Investment. The underlying asset here, is an investment. So that 50 impairment loss shouldn't be in operating expenses at all. Other operating expenses now should be 650. And in fact, the share of the associate's profit of 20, there needs to be another line there where you're saying, yeah, impairment loss on the investment in the associate 50. And although that won't ultimately affect the profit before income taxes, it does affect the measurement of operating profit. And so that needs to be corrected. Yeah, the 50 million was categorized in an incorrect way. Did you get the third one? Did you spot it? Where's Wally? Did you spot it? and it's to do with the subtotals. Well, I can see operating profit, which in the Virgin question is 700, and I can see in the question 200 as well, the profit. What I can't see in the question is the subtotal of profit before financing and income taxes. So from an IFRS 18 perspective, there are three distinct things wrong with this profit and loss account, the way it's presented. And you need to have the skill, you need to have the knowledge, first of all, and then you need to be able to apply that knowledge, identify it, explain it, and if necessary, even correct it. All right, well done. Well done. Now I'm going to keep on. I'm going to keep on banging on. Same set of data, this time more investor focus. Rather than correcting the standard, I'm thinking about an investor focus. And the proposal is that the directors are wanting a bonus if next year's profit is doubled from 200 to 400. Is that reasonable? We need to advise the shareholders who may have a vote at the general meeting as to this information, as to this decision. And if the information is presented to you, they have to interpret it, and we have to help them come to that advice. I wonder what you think. I wish I knew what you thought. Maybe you need to buy yourself a minute to think. That's what you do in the exam. You think. Answers aren't always going to jump out at you straight away. Be prepared to put this video on pause whilst you think. Do you think it is reasonable for the directors to get a bonus if next year's profits are doubled from 200 to 400? Yes or no? Well, I know what I think. I think it would be an absolute scandal if they were awarded a bonus. And that's because I understand the way that the profit and loss account should be presented. And I understand that the impairment losses, which have been disaggregated and shown, and the discontinued loss, these are non-recurring items in nature. Yes, we have to include them in the P&L. They have to be included in the P&L. Faithful representation, these are losses, they must be reported. This year's profit is 200, and if you exclude them, you're being incomplete. So they must be reported, but they're going to be presented in a way which is relevant. They're going to be presented in a way which helps you make an extrapolation and a prediction. Useful information is relevant, is forward-looking. And therefore, in my opinion, in my judgment, a profit target of 400 is simply not stretching, because fundamentally, although this year's profit is 200, when you strip out the non-recurring losses, it's actually more like 680. If all they do is the same business next year, but they avoid the impairment loss, they avoid the damage, the fire, they won't have the discontinued dragging them down again, next year's profit will be 680. So kind of, if you want a stretching target, if you want it 10% higher, set a target of 750 or set a target of 800, whatever. That would be stretching. A profit target of 400 is not stretching. Use your judgment. Get off the fence. Understand why the information has been given to you in the question and make sure you put it in your answer. I hope that is clear. I hope, that has been useful to you. Right. MPMs. You know what MPMs stand for. They stand for Management Defined Performance Measures. Let's be honest about it. Most businesses boast. Most businesses tell the public, tell in the press release, profit that is not necessarily directly lifted from the P&L. It's some sort of adjusted figure that the management have defined. It's a subtotal of an income and expenses which the business uses. Okay, so it's not free cash flow, because that's to do with cash flow. And by the way, it's not profit before tax or gross profit, because they are specifically excluded. So an MPM is a subtotal, is a profit, yeah, that the entity uses that is not defined by an accounting standard, not required to be disclosed by an accounting standard. As I say, many companies do it, things like EBITDA, things like, underlying profits, whatever. Now, if you've got a management performance measure, you must make a disclosure in the notes. There must be a transparent disclosure so users understand the significance of that number. The management have to describe what the profit measure is and why they think it's useful, why they think it's relevant, why they think it's a faithful representation, even though an accounting standard doesn't mandate it. They've got to show its calculation, and they've got to reconcile that MPM to a subtotal required by IFRS 18. That's the knowledge. But in the exam, we're probably going to be applying that knowledge, not just regurgitating it, applying it. Have a read. Have a think. Here am I holding my latest grandson. That's what I'm looking at. But you're looking at a requirement which is talking about reconciling what? Weller has publicises that its profits, its underlying pre-tax profits are 100 million. That's a phrase that Weller's invented, underlying pre-tax operating profit. Now, such profits exclude reorganisational costs and share-based payments. And the justification is that somehow these are non-recurring, non-cash items, whatever. The reconciliation. Maybe you've done it in your head already. I kind of hope you have. But can you reconcile the 100 million that they are boasting about as an underlying pre-tax operating profit? Can you reconcile that back to a figure required in the P&L? Can you reconcile that back to operating profit? Put the video on pause if you need to. But the answer is 75. What's the question? Well, the answer is 75 because if you are reconciling your underlying pre-tax profit, they've excluded the reorganisational costs and share-based payments, but those are expenses that are charged in arriving at the operating profit per the operating profit per the P&L. So the operating profit per the P&L is 75. Now, I am cynical. I'm old and I'm cynical. Perhaps I should say I'm experienced and I'm cynical. Companies, when they are producing a management-defined performance measure, almost inevitably produce a profit which is higher than the one shown in the P&L itself. That's why they're highlighting it. That's why they're boasting. Yeah? So they are stripping out the organizational cost. They're stripping out the share-based payments. And now, same data. Instead of doing the reconciliation, we're being challenged to evaluate the usefulness, to comment on this particular MPM. Does it make sense to you? Do you agree and understand why the directors have excluded the reorganisational costs? Now, they've excluded the reorganisational costs on the grounds of they're non-recurring, and they've excluded the share-based payments on the grounds they are not a cash expense. So let's put ourselves in the shoes and the heads of management and in the eyes of the investor. Does that make sense? Does it make sense? Well, I'm going to say no. I'm going to challenge. Reorganizational expenses. Every company I've ever worked for has periodically and on a regular basis reorganized. It's just what organizations do. They centralize, they decentralize. Yeah, they work themselves up, product line divisions, geographical divisions. They change. It's the nature of business. It may not happen every single year, but it's certainly not, in my view, an unusual item. It's a recurring item. Now, they've stripped out the share-based payments because they're non-cash expenses, but there's no mention of depreciation, there's no mention of impairment losses, there's no mention of provisions, there's no mention of other non-cash expenses. So my head is spinning. Either they are stripping out non-recurring items or they're stripping out cash. It's muddle thinking. I think it's really muddle thinking. And I don't actually think this particular management defined performance measure is of significantly useful to the user. And I can only form that judgment because of the disclosure, the reconciliation and the information. So investors have to appreciate the disclosures given to them and form their own view of them. All right, management are trying to be helpful, but we've got to be a little bit cautious, and we've got to use our minds. So I think in this particular example, it's muddle thinking. Good. Thank you very much for bearing with me. Thank you very much for listening to me talk about IFRS 18. This has been a topic explainer. My name is Tom Clendon. I'm a tutor expert. Yeah, I'm an online lecturer. I help students pass SPR. I also produce other content for ACCA and podcasts and on my YouTube account as well. So thank you very much. Keep studying, keep the faith, keep thinking.